All right, welcome back to Small Talk. Now, for those who don't know what Small Talk is, we are a segment under the Den of Truth where we invite guests to speak about financial literacy, to politics, business, startup, technology, essentially creating a pipeline of information for the youth and anyone who is watching this to be exposed to new information so that you can take some practical steps in your life around ownership to inspiring yourself to be a leader in your generation and passing that information down to the next generation. So that's what Small Talk is all about. Now, today, I want to talk about a topic that resonates with, I think, all of us, and which is money. And income inequality is a big part, right? We constantly hear the rich are getting richer, the poor are getting poorer, and there's a myriad of reasons of why that's happening. Obviously, we talk about rich people are taking advantage of the system. They know how to manipulate the tax system, or the fact that they have friends in the government, and businesses receive government subsidies and all this sort of stuff. But one thing I think is very significant, and this is something that you can take control in your life, in my life also, and that's just choices. The fact that a lot of us don't know how to manage money, a lot of us don't know how the money works and how to make it work for us. And as compared to rich people who know how to do that, that's why we're seeing richer get richer. And we're seeing why middle class is shrinking, why lower income families are struggling, is because the choices that we make every day, the situation, the circumstances that we're in. So just starting off from the foundation of how do you manage your money, how do you know money works, and how do you make it work for you, will significantly get us out of this situation and shrink the income inequality gap. And today we have someone that is very special. He runs a personal finance channel where he gives advice around property, NFTs, how to invest your money, how to approach money. He's also a buyer's agent, so he helps consult and finds property for you and manages for you guys as well. We have Ravi Sharma. How you doing, my brother?
I'm good. Thanks for the invite, man.
No, I appreciate you for jumping on, man. I think this is going to be an exciting episode. Like I said, resonates with a lot of us. Money is the root of a lot of things, right? Like where I come from, where Southwest Sydney, there's a lot of social disparities, a lot of social disadvantages, and it all stems from investment in our community and where does our money flow into? There's a lot of consumerism, but not enough ownership, and lack of money leads to a lot of social issues like crime, to lack of infrastructure, to just bad influences and not knowing how to take paths in life. So, that's why I'm really excited to have you on to share about your insight of, how do you manage money and how does it work? But before that even happens, right? Yeah, why don't you introduce yourself, man? Your journey to financial freedom, the fact that you did, and you can explain, FIRE strategy to building a $6 million plus portfolio by 30, and what you do for a career, man. I'll leave it to you.
No, I appreciate it, man. My name's Ravi, and I run a personal finance channel called Personal Finance with Ravi Sharma, and I run the buyers agency as well. So we're helping a lot of clients get into property, and it's one of those things that I guess for a lot of people it was I could probably never afford to buy property. If I live in Sydney or I live in Melbourne, it's like, shit, man, how do I spend $800K? I don't know how to get that.
Yeah.
So for us, our focus has always been investing, rent vesting, and that seems like it's a bit more relevant to our age group. So I'm 29 now. I started with investing in property as well, and this was like 9 years ago. Pretty much got to the point where I was just making money from my job, and I worked all throughout uni as well. And I got to the point where I was making money and I was just spending on like ASOS and just, clothes. And I wasn't going anywhere, but just, and then my dad comes home every single time and he's like, freaking hell, like you just got so much
ASOS
clothes. Like, why
in.
do you have this? Like, what are you doing? And then he goes, I think you should put some money towards property and just get in. And I was like, well, I can't buy anything in Sydney. Well, what else do I have? He goes, bro, Australia's big. Like, find something, do the research. And so I ended up finding something, regional New South Wales, got my first property. And since then, it's sort of been like, it opened up my eyes to go, there's another way around this, So for me, I've just been building property and built my foundation with that real estate stuff, which is traditional. It was, in my eyes, a lot safer than going for the more spec plays. And then I got into crypto. and got into NFTs in the last couple of years, and that's been very fruitful. But yeah, the buyer's agency is my main gig, and then I'm very passionate about sort of having conversations like this, sharing knowledge around personal finance, property, NFTs, crypto on the channel. So yeah, it's just been an exciting journey so far, but I feel like I'm just getting started.
Yeah.
And I love the fact that, you guys are doing stuff in this space, and there's more and more people that are coming, having decent conversations around this.
Yeah, no, I appreciate it, man. I feel like, it's what we're taught about in our system, or like just throughout school, has always been very traditional. And I feel like year on year, a lot of young people want to have more ownership in their lives. They just don't know how to. So it's really good that there's a lot of people coming out and exposing some information for us to take in and just take practical steps. Right now, for today, Ravi, you're specialized in property, you specialize in NFTs and crypto, but I want to start from a high level today, where this is for the audience that don't know how to manage money and how it even works, just to get you guys on the right foundational mindset first, and then later in the episodes in small talk segment we can talk about, we can bring you again and other guests to talk about asset classes like stocks, property, crypto, and all those sorts of things, and business as well. But today is very high level. Now, before we even get to how we talk about money and inflation, all that sort of stuff, everybody has different goals in life. Everybody, some people are happy to work in a corporate job and settle down and get married. That's okay. If that's what you're really happy about, that's fine. If you want to have ownership and own a business and not retire and work to the rest of your life, but that's your own thing, that's cool as well. It's whatever you're happy and aligned to, right? But for yourself, your focus, and correct me if I'm wrong here, is a FIRE strategy. Now, we won't get too much into what FIRE entails, but what is FIRE strategy from a high level, if you were to elaborate in a sense?
Yeah, so FIRE basically means financial independence, retire early, right? So this movement really started over the last couple of years. People realized, hey, there's another way out. Maybe I can just reduce my expenses and then be living, on my own terms. Don't have to be answerable to anyone. For me, I feel like I got there a few years ago. So I was fortunate enough to get there about 24, 25. And then from there, it was like, okay, I've retired on paper, but am I liking what I do? Am I actually happy? What's my purpose here? And that's what the last couple of years has been for me in my journey to go, I can build my portfolio, make more money, but I think happiness is the North Star. So for me, it was about shifting to go, hey, you know what? Financial independence on a very basic level allows you choice to then go, I don't have the financial stress of now taking a job that's going to pay me $20,000 or $30,000 less, right? So that was the whole idea behind what I was doing. Now moving forward, it's going, how do we educate enough people to go, exactly to your point. You want to buy a house, you want to live in the middle of Sydney, you want to have a unit, you want to do those things and that brings you true happiness, go for it. Just don't compare to anyone else, right? Always, spend what you can afford to spend. And I think there's too many people flexing with things that they can't actually afford to flex on.
Yeah.
And so that causes more financial stress. So my thing is, dude, just do what you're effing happy about, right? And if that pays you $30 an hour or it pays you $450,000 a year, it doesn't matter. It's just as long as you're happy. And, people might come out and they're like, oh, it's easy for you to say, you got money, you got this and you got that. So that's the mindset that gets you there. If you're working a job that you don't like, maybe the motivation for you is, how do I do this for the next 10 years, build up a portfolio so that I don't have to do this shit that I don't like for 40 years. I can actually leave. And believe it or not, with Web3, blockchain, even property, you still have the opportunity to go in, build a portfolio for yourself and get financially free, which means I'm not signing up for this shit for 40 years.
Yeah.
I can do it, in a lot less time.
Yeah, 100%. I feel like, man, we're talking offline before, where it's like previous generations the trends of what their life trajectory was. You can work one job for 40 years until retirement and get married and buy a house that was probably less than $100,000 back in the day. And they pass that knowledge down to their kids oh, why don't you do the same thing? It's kind of hard when the world's moving fast and there's so much involvement in technology and inflation and there's just so many things, and ownership is becoming a very big topic where people want to buy back their time. People want to have financial freedom, and if people are aligned to financial freedom and they want to live a life where it's stress-free and they want to do their own thing, this is the episode for you guys. Like we said, do what makes you happy, but if you're looking to get out of your situation and have some freedom in your life, this is something that could resonate with you. Now, before we even talk about investing and all that kind of stuff, let's talk about how we were taught about money, right? The fact that, like I said, it's always been go to school, get good grades, go to uni, get a good degree, get a job 9 to 5, then save money in the bank, then get married, buy a house, and then retire. You know, that's all sound and all, but let's actually expose a little bit about this issue where you save your money and then you go get a loan from the bank, right? And you buy a house. Let's actually talk about here is what banks are actually doing with your money when you save in the bank, as opposed to what you actually get out of that when you put money in the bank. So can you break that down?
Well, the simplest way to do it, right, is let's say, for instance, you want a loan. You go to the bank and they'll say, hey, you want a loan? Okay, great. We'll help you buy the house. We'll give you 90%. You just put 10% down, and we'll give you the lowest rate, which is like 2.5%. That's if you want to buy a house, right, which benefits them as well. Then you go on the flip side. If you go there tomorrow and you say, hey, I want some cheap debt. Can I have some cheap debt? They'll go, yeah, you can have a personal loan, you can have a credit card, but that's 7% or that's 15%. And that's how they're making the money off the money you gave them, right?
Yeah.
So fractionalized banking and all of that, like it gets nitty gritty, but at a very high level, they're just taking your money, using that as, a base, and then being able to go out and just lend out to more people at a higher rate. They're profitable, right? That's the game for them. And so that's essentially what they're doing with your money. And that's not necessarily a bad thing, because once you understand the rules of the game, you can actually win the game, right? There's never a time where you've played a game or you've just been introduced to a new trading card game or Monopoly or whatever it is, and you're like, I don't know how to play this. Can you explain the rules to me? That's what you get asked, right? That's what you ask. I hope you do. Otherwise, you're going to lose the game. You don't even know how to win. But when it comes to reality and it comes to life, we're just going, the set of rules that we need to follow is what my parents did and the grandparents did. And that was get married, buy a house, retire at 60 or 65, and then that's it, right? We're not asking what the new set of rules are, because every 6 months it changes. And that's where people got to adapt. And on my channel, I say, adapt or die. And that's pretty much it, because, it may not feel like that now, but compound that over the next 10, 15 years and it gets pretty scary.
Yeah.
People arguing that, housing affordability is a concern. This has been a concern for 30, 50, 60 years. Now it's like, okay, well, because we're living through it, you're getting affected, I'm getting affected. Now we're going to make some noise about it. And obviously information travels faster now anyway.
Yeah, 100%. I feel like, just what you're saying, for those who don't know what banks are actually doing, and you think that you're just putting your money in, you're saving $1,000 every month, right? And that $12,000 at the end of the year, you think it's just sitting there. Not really. It's them giving you an IOU slip, and that they're now putting that $12,000 somewhere else for someone else to borrow that money. So they're making interest off your money, while you sit there with probably less than 1% interest a year, and that's a stitch up in my eyes, right? Because what they're actually doing, they're working on your hard-earned labor for them to give that money out to someone else to make more money off your money. So if you're not getting a share of that, then you gotta do something else. You gotta reprioritize what's going on here.
Yeah, for sure.
Now, saving money is a sound investment if you are investing for something, right? So if you're saving money just for the purpose of saving, what are you actually doing, right? It's just sitting in that bank account doing nothing at all. But if you're saving money to invest in a property, fine. If you're saving money to put in an asset, fine. If you're saving that money for business and that's what your goal is, then great. But if you're saving for the purpose of just saving, now, there's a thing called inflation. Now, everybody knows inflation. Everybody's experienced inflation. You go to the gas station right now, you're paying $2.30 or something for a litre. Or the fact that food prices are increasing and rents is increasing, houses increasing. But, when you save your money in that bank, can you break down what is inflation and how does that affect the person that is saving that money in that bank account?
So the easiest way to probably explain inflation is how much by a percentage does the currency die? Okay, so basically for anyone that's sort of listening and sort of goes, well, what the hell does that mean? It's like if I was to go and use $100 now and go buy a basket of goods, being groceries, that $100 worth in a year's time will only be worth $97. So I've got to take out one piece of grocery that I can't afford now. And that's just how the system is. It's just how it's been built to go, we need inflation in the system because we need the economy to keep growing, right? And that's healthy within the target band of 2 to 3% for the RBA. But where we're at is a lot higher than that. And the main reason for it is because when we went through the pandemic, people were sitting at home, they didn't have to work. We had businesses shut down. So there's no organic sort of economic activity. It was the government is funding everyone's lifestyle to go, hey, you need to sit at home because we have this pandemic, right? Now, all that money that starts flowing in the system, you sort of start questioning going, well, where does this money find its way to? Suddenly everyone's got $700, $600 and you're sitting at home. Where does it go to? And it's usually asset price inflation first, which is why we've seen real estate take off. You saw shares, you saw crypto all-time highs. And that's because all that money is now disposable income for a lot of people. And they're going, oh yeah, I'll just, use the 100 and make 200, right? So that's how inflation really works. It's just when more supply is available and yet the actual assets available are still, finite. They're still the same. You have more money, which means everyone can outbid each other, and that's how we see asset price inflation happen. When you come to, things like food and whatnot, you could buy a Happy Meal, 20, 30 years ago for a couple of bucks. Now it's going to cost you $10, $15, $20. And yes, people will go, well, people were making a lot less back then as well, but it's like that whole wealth gap of the rich getting richer and the poor getting poorer. It's because the rich that end up making some of this money, they go and invest that. Whereas the poor need that money for their weekly rent. And that's just how the system's been built, which is unfair. But we didn't make the rules, right? I didn't make the rules. People didn't start buying property because they saw my channel on YouTube and they're like, yeah, I'm going to buy property. No, they didn't do that. They were doing it well before. So now that they've been doing it for ages, it's now understanding the rules of the game and to go, okay, now I understand what inflation is. If I go and save my money, if I make 1%, if inflation is 3%, that means I'm losing 2%. I'm basically losing money and flushing it down the toilet every year, right? And because it happens at such a slow or, small pace, people don't really realize. But because of the pandemic, everything got accelerated, which means now there's more eyes on the space going, oh shit, like, you know what? I do feel petrol's higher. I do feel like chips are more expensive.
Yeah, 100%. I feel like it's kind of waking up everyone, right? And pre-COVID, it was like 2-3% inflation. It was just, we're sleepwalking, but then if you actually look how it compounds the rest of your life, that's a major impact, but your money's just being eaten, right? 3%, 3% every year.
100%,
and now it's like 7%, 5%, like even in the US, it's 10%.
That's what they're reporting, though.
That's what they're reporting, right?
It's a lot higher than that.
Yeah, so... Mate,
and do you know what's not in that basket for inflation? Land.
Damn.
So if you include land, like I know for a fact real estate's gone up by 23 to 28% over the last 12 to 24 months, right? Yearly. Why is that not in the inflation target? Because if that was, it gets pretty skewed pretty quickly.
Yeah, and then people are starting to riot. But guys, we got to wake up. We got to realize that, mate, the more that you just save your money in that bank, you are actually losing value. That dollar is not worth the dollar next year. So that's why you guys should care about inflation. It's eating your money alive. Just the fact that, if you're working for earned income and you're saving your money, you're stitching yourself up in a way where money is just being flushed down the toilet. And if you're just relying on earned income and there's no other means to make money or passive income, or you got no side hustle or anything like that, someone told me something, a very interesting quote was, your salary is one step away from poverty. So if you lose your salary, you're pretty much screwed.
Yeah.
So definitely start thinking about, how inflation affects you, and start thinking about if you're saving something, save with purpose. If you're not, then start thinking about investing. Now, before we even get to investing, right? Because everyone's circumstances is different. Where I come from, I see a lot of people in debt. I see a lot of people struggle with money because it's easy for us to say, hey, invest your money. But it's the fact that what you said, rich people have disposable income in which they can invest in businesses and employ people and invest in other assets. Middle class and lower income families don't have disposable income. They got money where they have to buy just means to live, food, groceries for the kids, for health. But, so before we even get to investing, there's a lot of people in debt. What should you do first? I'm keen to get your thoughts on, do you get out of debt first before you invest? Do you set yourself up with emergency funds? If so, how long? What are your thoughts on just setting yourself up before you even invest?
I think with investing, it's like a muscle, right? So you go to the gym, same way. You can't just go in and say, oh, I feel great today. I've never lifted weights in my life. I'm going to lift the highest that anyone in the gym's lifted. You're probably going to get injured if you can even lift it, right? You got to work your way up there. So if you're someone that's in debt or you haven't got that financial literacy, no one around you taught you that, it's unfortunate, but it's now accountability. It's now going, no one else is going to teach you this shit, right? If you're in the position you're in, unfortunately, tough love, is you deserve to be in that situation, right? And that's such a harsh thing to say. I know my own family, like there's people in my family that are in that position, and that's the reality. But once we get on terms, right? Once we realize that this is our own actions that we've got into this position, it actually empowers you. You start thinking, hey, if I got myself in this position, I can get myself out. So it's actually a healthy way to look at it. Whereas most people don't want to say it. They're like, oh no, don't say that. Someone's going to feel bad about it. Everyone's got different situations, and 100% they do. But it's all your actions leading to this point. Now, I'm not, I'm empathetic towards that. Some people have a different starting point. That's 100%, right? I had a different starting point to you and you had a different starting point to someone else. But that's where you've got to take accountability and go, well, my goals are different to yours as well. My lifestyle is different to yours as well. So now we just need to figure out what's unique to us. How do we start this process of building those muscles? And the first way to do it is, you've got free education around. Go and just absorb that information, books, podcasts, YouTube videos. Just go and absorb, just be in those right conversations. Start playing it in the living room. Because if you're someone that's like 60, 50, 40, right? You might be thinking it's too late for you. But if you're living till 80, 90, 100, you're only halfway there, right? So you've got to find out how you can grow wealth for yourself, but then also instill the right money habits as well for your kids. So it might be that you may never get to financial freedom, but you might have some actions that you do or good habits that you do for the next couple of years that actually does get your son or your daughter into financial freedom in their lives. And that's going to be so important.
Yeah, no, 100%. I agree with you, and I feel like it's a harsh message, and I get a lot of blowback as well when I say it's your choices that determine where you're going to be in life and just how you even manage money, right? Like I said, where I come from, to tell someone it's your fault. Look, at the end of the day, everyone's born in different circumstances. People are born in a situation that they didn't wish for, and they had a higher disadvantage than someone else. But it's the fact that, we're all getting older. We're all going to be grown-ass adults. And as a kid and you're young, probably when you're 18 and someone tells you that, you're like, man, fuck you. I'm like, I was born into this situation. You can't tell me to invest. I get that. But look, at the end of the day, you're going to grow older. You're going to be your own person, and you're going to be an adult. And you're going to have to start thinking, man, I'm born in this situation. I'm aware of my circumstances and I'm aware of the factors that put me in this position, but I need to take control of that situation so I can get myself out of it and my future family as well. So it's just the fact that, realizing that, everyone's born in different circumstances. You got harder circumstances than someone else, and that's a lot of people from where we come from, but just understand that there's accountability in your life, and the choices that you make will either determine whether you fall worse or you're going to get up. And if you, like you said, if you don't buy freedom at the end of your life, you've still learned that foundation and pass that on to your kids so that your next generation gets out of that situation, right? It's just breaking that cycle of poverty and breaking that cycle of trauma and just working backwards and 9 to 5 every single day and just getting out of that situation. But yeah, man, I feel like the strategy I'm always hearing, right, is very common. It's like, before you invest, get out of debt first. Get yourself out of debt, and then if you're gonna quit your job or before you even invest in anything, make sure that you set yourself up with an emergency fund for 6 months and put it in a high interest savings account to offset inflation, obviously. Do you think that's a sound strategy? What are your thoughts on getting out of debt and then setting yourself a fund for 6 months before you put any other income into something else?
Well, I think for some people, it helps them, have the peace of mind. Sleep at night factor is what I refer to it. And if that means they need to get out of debt first, awesome, do that. There's other people that are like, well, my debt is costing, say, 6%, but if I invest, I can make 8%. I'm technically net getting higher, right? I'm getting forward. I'm going forward. And so it really comes down to the individual. For me, I wasn't in debt. I started from a fresh, clean slate. Everyone's got HEX, so I had that. But it was just about, how do I spend the next 6 months to 12 months educating myself before actually pulling the trigger? Because what ends up happening is if you suddenly get into something too quickly, chances are you have this revenge mindset, which is I'm going to try and get there a lot quicker. I try and get the 100x instead of the 10x. Everyone's jumping on crypto at the moment. You got meme coins and then you got NFTs, and they're going after shittier projects because they want to make a quick flip. They want to make quick money. Why? Because they feel like they've been underwater for so long that they don't want to start building the foundations. And to be honest, bro, the first 5 years of investing are freaking boring, right?
Yeah.
I know for a fact I was doing it and I'm like, far out, like, does it change? Does it change? That's when compound growth, kicks in. And you building a foundation that's boring means it's stable, right? Then you can start taking a bit more, spreading your wings into things you're passionate about, what you like. For me, one of the first things I started doing was after I bought property was starting to buy Pokemon cards, right? And so for me, it was nostalgic because I grew up with it, but then I started understanding the mechanics. I understood consumer behavior. So that, float my boat. But others, they want to go into ETFs, shares, whatever. But I think this whole idea of emergency fund, how much, how much is too much, it comes down to the individual. If you think you're starting a business and you're probably not going to find a client for, say, 6 months, yeah, then you need 6 months, right? Worth of emergency funds. But then everyone else got a different number.
Yeah, 100%. So, word of advice to people to summarize, depends on your situation. If you're in debt, and you understand that your debt is lower than how much you can invest and make that net, go for it. If you're in debt and you notice that even if you're going to invest, you're still going to be negative, get out of debt first. If you have a situation where you're working at a job and you need to quit, set that up for 6 months before you do anything else. But if you think that you can afford to live without an emergency fund, it's up to you. But start thinking about getting out of debt. Or just consider your debt and also an emergency fund before you go investing. Now, we talked about how we talk about money and how the system is wrong and how it's working against us, to how inflation is eating your money up from your labor, to set yourself up before you even put your money anywhere else. And the answer is to invest. I think how you think about it is, why should you invest? It's to beat the system. It's beating inflation. It's the fact that you need to keep the rate beyond inflation. So that's how you preserve your money, but also build wealth at the same time. Now, why, in your opinion, why should people invest? Is it to make money work for you and buy back freedom? What is it? What's your word of advice of why people should invest?
I think if you were to, say, open up the rule book for life, right? Everyone wants financial freedom. They might want to, for some people, it might be living in a rural town somewhere. Nobody knows you. Someone wants to operate a farm in regional Australia. Some people want to live on a beach somewhere or go to Vegas every night. You know what I mean? Like, it's different for everyone. But when you start taking out the rule book, one of the first couple of rules on that is invest your money, right? Because that's how the system works. If it was about saving money, awesome. When I started investing, the interest rate that I had for property was like 5 to 6%, right? Which sounds absurd because we're at 2.5%, 3% at the moment. But at the same time, the savings rates, term deposits were like 3 to 4%, which is unheard of now because you're like 0.05% or whatever it is. Yeah. And so I think when you were to open up that rule book, you would find that investing allows you, a path to financial freedom. Simply having that money sit there in a bank account, knowing how the system works, means you're just falling behind. But again, what sort of risk appetite do you have? For some people, it's, I want to go heavy risk. They can sleep at night, that's fine. But for others, it's not possible. And I think that's what I've realized as I've matured up as well, that, you can't have a cookie cutter approach to everything.
Yeah.
And some people, to be honest, they don't want to ever get into debt to buy a property. And that's not my place to say. I like using leverage to buy property, but for other people, it's not the case. And there's no right or wrong answer. It's just, you need to accept the actions that you take now will lead to a certain path. If you're okay with that, awesome.
Yeah, 100%. I feel like, man, it's just, I forgot to mention, man, if like I said, if you're saving for a purpose, make sure you put in a high interest savings account. I mean, you're still not going to be inflation at this point, but at least it mitigates the number of loss that you're going to have from that rate, right? So for those who don't know what's a higher interest savings account, Combank and Westpac and all those guys, like, that's your traditional, your mainstream banks, and they probably, what's the interest rate? Is like a percent or less a year. So high interest savings account, look for other banks that reward you, where they incentivize you to, if you put in a certain amount of deposit a month and you don't pull out at the end of the month, they reward you with a higher interest rate, right? Which is going to help offset inflation, and it's also going to help you get some kind of interest. But that's just the bare minimum that you should do if you were to save. And to your point, why you should invest is the fact that it's understanding what outcome you will get in life. It depends on your goals, but I feel where I come from, man. It's like you gotta make money work for you. If you gotta buy back your time. That's the whole point of living life. You have to buy back your time and be happy and have freedom. And the only way you're gonna do it is invest, and also the fact that hedging against inflation. I love to say beat the system, right? Because the system's built against you. You gotta beat the system that way, and a lot of people can't visualize when you say invest, like what's really the impact. They want to see the numbers, right? And like we said, like you touched on, compound interest. The people always like, what's compounding? What does that even mean? What does that even look like? Can you explain the concept of compound interest and why is that so important to, that is basically why you invest. So why is that important? And what is
Yeah,
it?
I mean, some people call it the eighth wonder of the world, compound interest, compound growth. Essentially, it's like if I was to save $100 this week, right, and then $100 the next week and 100 the week after, if I don't invest that 100 is still 100 and that becomes 100 plus 100 is 200, right? At very simple level. If I'm to go and compound, that growth, and let's say I'm in something that's growing at 5%, that 100 that I had initially becomes 105. Now, that 105 now has another 5% of growth, but it's not on 100, it's on 105. And that's how we get to the point where it starts sort of accumulating. And it's like, when you're rolling down a hill, you build momentum. And that momentum, you're not really going to see in the first couple of years, but after a while, you see it in 10, 15, 20 years. And that's what compound interest is.
Awesome. And I'm gonna show the audience real quick on the screen share is that just to visualize that number, right? Now, we're working with 1,000. Let's say that you're working your earned income, you're working a salary, and you save, let's say, $1,000 monthly, and you save that for 20 years, right? The deposit that you're putting in and how much you're saving is $240,000 at the end of 20 years. That's excluding inflation, by the way. And as compared to investing that money, and let's say you invest in an asset that grows 10% a year, instead of having $240,000 at the end of 20 years, that's $725,000. So you've literally gained an interest of nearly $500K just because you invested. Now, as you said, Ravi, the first couple of years, as you can see in the graph on the table, it's not much, right? It's really fuck all. It's like 1, 2, 3, 4, and 5. That's when you're saying investing from the first 5 years or so is so boring. It's just these measly returns, and you think, is it really worth it? But if you look down, when it gets down to the ladder of 10 to 15 to 20, you can really see the impact of compound interest, in which has led to $725,000 at the end of that 20 years that you invested. So that's what compound interest looks like, and a lot of people need to think that get rich quick schemes and what you said, revenge, in terms of they're in a bad situation, they want to get quick returns or so. None of those things last. Those are things that any quick money is not sustainable money, right? And people need to think that if I'm going to invest, I have to think long term. It's 10, 20, 30, 40 years down the track. It's the fact that people need to invest for themselves, but at the end of the day, it's for your next generation, right? Like where we see a lot of people in Sydney. There's a lot of rich people out there, and it's not because they did it in one lifetime. That's old money. That was someone that was started like there was when I say generational wealth, there was that one person that was unselfish, where they sacrificed, and then they passed that wealth and that knowledge down, and their kid multiplied that, and their kid multiplied that, and that's how you guys should think about investing and building a foundation for your life. So yeah, man, and a lot of people would ask, well, how much would you invest? And this depends on people's situation as well. It depends on what's your risk appetite, obviously, right? But a lot of people, and I get a lot of pushback because people ask me, oh, how you manage your money, and I'm just like, you need to invest. You need to put money in stocks. You need to put money in crypto, whatever it is that you're comfortable with. And they always say, well, I don't want to invest because it's too risky. It's the risk is unknown. I rather save and I rather work something that I can just see and not lose. What do you say to people when they say it's too risky to invest?
Think about it this way, right? If you zoom out and you look at the value of the Australian dollar or the US dollar, over a period of time, it's actually lost 99% of its value. So if you're not investing into assets, right, productive assets, property, real estate, NFTs, crypto, whatever it is, right? Everything's got a risk appetite. But if you're not investing in that, you're investing in the dollar, which has lost 99%. So for me, in my eyes, it's riskier, in my opinion, to have that invested in money and the dollar, because that we know has dropped by 99%.
Yeah.
So I would rather get, even if I was to just move sideways, if you went into, say, something like gold, that's why people use that as a hedge against the entire system when it came to, global financial crisis and whatnot. So that's how I look at it when I'm investing. If I'm not investing into these things, I'm investing into the dollar. And if I'm investing into the dollar, I've lost 99% over a period of time.
Obviously, we touched a little bit earlier of why the dollar loses value, right? But obviously supply chain issues and disruptions and food prices going up because of those things. Even petrol, obviously, because the shortage, the year on year, there's always going to be less supply of fuel, and that's why it's contributing to inflation. But one big part as well, I think, and correct me if I'm wrong, is the government printing money. Is that correct?
100%.
What is the concept of that? Why is the government printing money, and does that play a big part in inflation as well? What does that look like?
So think about it like this. If you're trying to start a fire, right, and that you can see, if you've got a barbecue or whatever, right, and you see the actual fire, it's dying out. What do you need to do? You need to have something instigate more fire. And what you do is like a fire starter or more coal or more wood or whatever. Yeah. You're putting things into the system. That's what we needed to have happen here in Australia and around the world. You had central banks kicking in because the fire was going out. And the fire was going out because, obviously, we had pandemic, right? The whole world shut down. So if they didn't do that, we find ourselves in a massive depression, right? So not even a recession, which is 2 consecutive quarters of negative growth. A depression is 4. We already had the recession. Everyone tried to avoid the double dip recession by pumping more money in. So that's effectively why they did it. The whole system shut down. So the entire economies around the world just shut down. So when you have to then go, oh shit, we've got to keep the system alive, you got to put more shit in there. And once you put more shit in there, right, now you've just got a lot more excess. So when things start running well, you have that fire escalate to becoming like a freaking massive, big fire. Yeah. And that's exactly where we're at.
Man.
It's like, if you're taking out the toothpaste out of the tube, they kept pumping it out. Now they're going, how do we put it back in? Well, you can't. You just can't. And so if you can't put it back in, now it's out in the system. And that's why we see inflation. It's not this idea of just solely because there's issues around the world, there's shortage of supply chain disruptions and things. It's not that. It's just that everyone's got more money.
And I feel like money's always going to be printed, and obviously that analogy of the toothpaste. I mean, down the track, man, like where do you see the impact of this cycle going? Like what's that looking like? Because when you say like that, it's a pretty grim picture of where we're going, right? So I want to, if I was to level set again, because the government's printed so much money to avoid a recession, a lot of people don't understand the concept of a bubble or anything like that. So can you break down what's the long-term implications of printing so much money? Does that lead to a bubble? If so, what is that? What does that mean? And how does that affect our daily lives? And obviously the answer is to invest, but, how do we practically take actions to offset that or to even just mitigate that risk that we're facing?
So we've seen this happen a couple of times over, numerous years where you have the currency actually die, right? And then you have a different world currency, a global reserve currency, it changes. But the currency within your country, right, as it inflates, right, and we've got too much out there, they're going to try and control it to go, we need to contract the economy, lift interest rates and just calm shit down. If they can't do that, the inflation builds momentum, and that turns into hyperinflation. If hyperinflation happens, right, that means your currency is literally losing like at a faster pace than ever before. All right, so we've seen this around the world, Venezuela and things like that, where you suddenly go to the shopping center and you go, how much is this? And it could be worth 10 times more with your paper, right, with the paper money, because the inflation is out of control. That is pretty much where we could head if they don't come in, lift interest rates and calm things down. But it's very hard to do because even if you increase interest rates, you know, the people that are really pushing this economy up is the rich now have a lot of money. You know, if you've got property in Australia, over the last couple of years, you're building 20, 30% leverage returns, you're taking that equity out and buying another one. Now there's more competition. When there's more demand than supply, prices go up. The interest rates need to move to a point where you contract the economy. You know, people slow down. But at the risk that businesses go out of business, you have a lot of people that can't afford their mortgages. So then you have a housing collapse. So you can see how it's a balancing act. You can't lift too quickly to contract, but you also can't lift too slowly because then you have that momentum build hyperinflation. We have that scenario play out in the next couple of years. Things get very interesting.
And so it seems to me that, and we're diving into economics, and which should have been another topic, but you know, it's always a rabbit hole we go down here. But it seems like hyperinflation. Let's say, but if we don't solve this, where it seems to me that the only way that this really fixes itself is a correction. It's the fact that you have to let shit collapse if that's the case for it to recover again. And I feel like that's the cycle of it, because it's not popular during elections, right? Like someone's going to be blamed for the recession or anything like that. So it's always going to be pumping more money to keep this machine going. And that's been going for how many years in the US, and that's what we're seeing now. So, you know, it's the fact that we need a correction for that to happen, where things reset basically, and from there recover. So yeah, that's what it looks like. It's a pretty grim picture, but you know, obviously that's going to affect all of us, and how we manage and invest our money as well. So, you know, what are some of the practical steps as a normal day citizen, if this is the situation that plays out? What can they do? You know, investing and, you know, obviously beating the inflation rate is one, but practically, what would you outline right now if that was the situation? What would you do?
Okay, so education definitely, because you don't want to make the wrong move. The wrong move probably sets you back further, right? So you want to go, okay, I need the right people, the right conversations. Now there's so much information out there, it's probably too much information. So you've got to find yourself, you know, align yourself with people that are having the right conversations, talking about the right things, then get into those conversations to go, I need to educate myself for the next 6 to 12 months, right? Once you've done that, then you can start going, okay, I'm going to deploy cash here, deploy cash here, deploy cash here, if that's what you want to do. There are so many options. It's probably like the analysis paralysis part of it that comes in, which is I've got too many options. I don't know what to do. That's where you need to outsource. You know, that's why our buyer's agency exists, because there's people out there that haven't bought property because they're like, well, what happens if this happens? I don't know how to research. I can't buy anything in my backyard. You need to become a borderless investor. Or how do I buy property in a different state? You need to outsource that. Same thing, you know, if you don't know how to clean your own teeth, you go to a dentist. You don't have the machinery they have. Same thing, you know, I don't know anything about cars, right? So if something happens to my car, I have to call NRMA or I have to go and take it to a mechanic. I've outsourced it. So we're getting into this zone where if people love what they do, but they don't have enough time to invest into assets because they don't like that or it's boring, okay, everyone should have a financial health check. But if it's boring, guess what? We're in 2022. You can outsource that.
Yeah.
And once you start becoming, you know, you get that mindset where I don't need to be the professional. I don't need to be the guy for everything, right? There's parts of my life that I have no idea about. You know, I am so crap at cleaning the house. I have to get a cleaner, right? It's just, you know, otherwise I'm going to do a shit job. My girlfriend's going to yell at me. I don't want to have that conversation. But what I'm saying is, you know, back to the point where everyone's starting, you know, if they're starting fresh, you got debt, you got these things. Just start with the education.
100%. And I feel like this is now we're building up this context where there's inflation, people are printing money, we might be entering a recession or even hyperinflation, and there's going to be a market correction. This is such a common thing that I hear of someone who has some sort of idea investing is, I'm not going to invest my money, I'm going to wait until the market crashes, and then I'm going to put my money in. Do you think that's the right idea, or can you validate, you know, is that right or is that wrong? Or how should you approach or respond to those people who say that, because, you know, the whole circumstances that we're in right now?
Well, think about it this way. If you were told in 2019, right, that in 2020, the entire world is going to shut down because we're going to have the pandemic, and then in 2 years after that, we're going to have a potential for a World War III with what Russia's doing with Ukraine, would you have invested in 2019? No, you wouldn't have. But if you had invested in pretty much anything at that point, you'd still be higher than what you were at 2019. But that's the hindsight part, right? That's going, oh shit, if I knew that was going to happen, I wouldn't have invested either. I'm like, I don't know what's going to happen. But that's why if we're sitting there and just speculating, oh, like this could happen or that could happen, if you ask anyone and they had bought property or they had property or they had the opportunity to buy more property in 2008 before the housing market collapsed and you bought at the high, everyone would go back and buy because now you've seen the market and how far it's come. So my approach to it is have a strategy, have the right mindset, and if you can only afford to put in X amount, then only stick to X amount and go into assets that you feel give you sleep at night factor, right? There's going to be a risk with everything. But if you're in that market, stay in the market, zoom out long term, right? So I don't like this whole timing the market. In 2020, when the pandemic just started, everything started getting shut down. I was making TikToks, right? And my thought process was, look, the government needs to allow the market to reset. It needs to collapse, right? It's not a popular topic. I had a lot of debt as well with my real estate. I was like, look, it needs to correct. However, my assumption is they're going to come and print money. When they come and print money, we had at the time, all these banks coming out and saying the property market is going to crash by 30%. I was saying it's going to go up by 20, 30%. Not a very popular topic. I ended up on TikTok and on Twitter, and people were starting to make fun of me, right? Yeah. Economists were coming out and were like, this guy doesn't know what he's talking about. So I took up a bet with one of them and I said, hey, I'm not a smart dude. You guys have obviously got, fancy pieces of paper on the wall. How about we have this, that in 2 years' time, if I'm wrong, I'll take you guys out for dinner. And if I'm right, you guys take me out for dinner. I didn't get a response, right? Yeah. And they definitely ain't responding now. Yeah. But what I'm trying to say is that, this idea of listening to the wrong people can get you into a lot of shit. That's why you need to know at least the basics of what you're getting yourself into before you even outsource, because you're like, okay, I know this guy's not taking me for a ride. Because everyone's looking for quick money, right? Trying to scam people out there. There's plenty of that.
Yeah, 100%. I feel like, so the best thing to summarize is there's no point of timing the market. It's just time in the market, which is going to help. So, for example, like we could talk about the .com bubble for one, right? Where Amazon's share price was one thing where it was skyrocketing. I think before the .com crash in like 2000 or so, and then the stock was pretty flatlined for the next decade or so. But the business was growing, for example, and then. Now anyone who's held that investment is now cheering because it's up to 3,800 or something like that, 3,300 to this date of the share price, right? And times how many shares you're holding from that time where it was like probably, I forgot what was the share, it was like $1, $10 or something like that. So the concept is don't time the market, it's time in the market, and it's the whole point of thinking long term. If you invest in an asset and you know that's a sound asset that you've outsourced to, or you have, you do your education, you understand what it is, and you need more specialization, go hire someone if you need to. But the time in the market is more important than timing the market, because even if we go through this period now where things crash and collapse, if you know that was a sound investment and you were given proper advice, it's going to be, you think long-term it's going to recover and you'll be making gains, as opposed to you just putting your money in that bank account and you experience the ride that everyone's on for, which is the massive inflation that we're facing.
Well, think about with Bitcoin, right? Cryptocurrency at the moment, volatile as F, right? It's super volatile. It'll go by 30%, could drop by 40%. Yeah. Everyone goes, it's a scam. Nobody cares about this. Well, it's the same shit that happened in the .com bubble. No one understood what these businesses were trying to do, because they're not growing for now. They're growing for the next 5, 10, 15 years. They're growing for the next phase. It's exactly what happened with Amazon, Apple, Google. And yet people are now going and buying, shares in those companies when they're like 100 times more expensive. Yeah. And it's because, yes, everyone's got that level of, certainty that, it's a real business now. Same thing is with these crypto companies, with these tokens, as well as, NFTs and things. We're at that point where people are in disbelief. The same time when people are like, the internet's a fad. That's where we're at. Yeah. And that's exciting for me, because once you understand the game, you're like, okay, I'm willing to spend time here. I'm ready to put money in, and money I can afford to lose because it could go to zero. You could have picked Ask Jeeves instead of Google. You'd be screwed, right? Do you even know what Ask Jeeves is?
No, I don't know.
There you go, right? So you could have gone down that path and you would have been screwed. Same thing's going to happen with crypto. Same thing's going to happen with NFTs. The ones that end up holding, the ones that become the next blue chips, they're going to make a shitload of money. But it's going to happen in 10, 20 years. But that volatility is opportunity.
Yeah. So timing the market, don't time the market. Just put your money in and invest in something that you understand, obviously, and you've been given sound advice as opposed to it's too risky. I'm not going to do it. All right. Well, I think we set up a very good foundation of just the mindset of how the banking system works, how money you need to work against inflation, and obviously investing and compound interest is the answer to these things. And the earlier that you're in the game, the more set up for success you are down the future, and think long term. Now, this is going to be. We're going to dive deep into each of these asset classes and things that you can invest in later episodes, obviously, and hoping to have you back for this. But what are for someone that is just fresh out of school or just hasn't thought about investing or doesn't know what's available out there besides salary? What are some asset classes available out there? Obviously we got common, but I'm gonna let you just list out a couple that are out there available for the common people to invest in.
Yeah, I mean, a lot of people understand how shares work. You're buying shares in a company that exists. You've got things like ETFs, exchange traded funds, which is basically like a basket of these, companies. And so that means it's less volatile, some cases. Then you've got something like real estate, but again, you need a large capital to get into real estate. Then you've got things like crypto, super volatile. Nobody knows what the F's going on. And, some would argue it's speculation. Then you've got NFTs that are built on crypto, right? Or on the blockchain, rather. So there's so many options like that. Then you go into alternative assets. I told you before offline that, I'm into Pokemon cards, right? Yeah. So I collect Pokemon cards. They go up in value. They go down in value. They're alternative assets. Some people collect sports cards, right? Memorabilia, sports memorabilia. So there's so many different avenues to go down, but people might get sick of hearing this, but it's like invest in your education, which is investing in yourself, right? Spend some time, instead of going and figuring out where my next 100 goes in, spend the 100 and get educated, whether that's online course, whether it's, having the right conversations with people and getting access to that, go and do that. Because that is going to allow you to go, okay, now I have a game plan. Where am I moving, right? Rather than jumping into something and go, I heard someone bought shares in this company, let me go buy it. You know what's going to happen? They're going to try and, refresh their page every 2-3 hours, especially with crypto moves so much, and emotionally you get tied up into it. Yeah. You're not going to get emotionally tied up into it as much if you have a strategy, you have a roadmap, and it's like, I'm not looking at this for the next 5 years. That's probably a better way to do it.
Yeah, 100%. And, we touched on it very briefly, but I'm going to let you say in your own words as well. We said property, but, what do you invest in? Like, list out the asset classes that you invest in right now.
Yeah, for me, I started with property. So real estate 9 years ago, and I've been continuing to purchase. I'm probably going to purchase a bit more next month, which is exciting. But I'm at that point where I built my foundation in real estate. For me, it was traditional. It was the safer stuff. I never got into shares and ETFs, mainly because I knew I could make more with leverage returns being real estate, right? Okay. So I understood that, and I wanted control. So if I wanted to increase the value of my property, I could go in and renovate. But if I wanted to increase the value of my shares, it's not like they're going to, Apple's going to invite me into their headquarters and be like, hey, come and, tell me your ideas. They're not going to do that. Yeah. Equally, I love the fact that I've got ownership with, hey, if I want to increase my rents or I want to change my tenant, I can do those things. Versus if Apple tomorrow has a scam that comes out, the price will tank and I have no control over that. That's probably why I'm self-employed, because I don't like someone else managing my money or, telling me what to do. That's why I gravitated towards property first. From property, I then got into your trading cards, you like your Pokemon cards, Dragon Ball cards and things like that, because I grew up with it. I understood it. But then that equally was like a passion project. Invested in myself, had numerous, businesses as well that I'm running at the moment, and then got to the point where I looked at crypto. I got burnt. I bought at the worst time, 2018. Everyone's like, hey, bro, like FOMO in, crypto's going to the moon. And so I was like, yeah, all right, cool, man. I'll buy some XRP, bro. And then, 5 months later, I've realized I've lost 80 to 90% of what I've had. And I'm like, oh, shit. I never sold because I was like, well, I put in money that I thought I could afford to lose. Mind you, it wasn't a lot. Yeah. And I was like, okay, cool. Like, it is there. I leave it. 2 years later, I start going, okay, well, there's a bit happening. All these companies started growing, They started doing things with the money that they had. And I could see the bigger roadmap. And that's when I started going back in. So dollar cost averaging back into crypto. And then I figured out what NFTs were. I understood the use case, whereas most people still don't understand that, and it's new. That's why people don't understand it. And so I understood it, spent a lot of time. I spent a lot of time researching that sort of stuff. So for me, it's the real estate stuff, trading cards, crypto, and NFTs. Those are my 4 assets at the moment.
Awesome, man. And dollar cost averaging, that's a term that we always hear, and we'll definitely dive deep because it's not applicable in every asset, but obviously it's such a common principle. But yeah, if you were to just, because the audience is going to ask me, what the hell is dollar cost averaging? Because you guys just said it. From a high level, in a sense, what is dollar cost averaging?
It's basically setting aside a certain amount during a certain period of time that goes into the market, irrespective of the price. So for instance, if you're dollar cost averaging into Bitcoin, you don't care if it's worth $60,000 today, and then in a week's time when you've got your automatic deduction or the reoccurring buy, you don't care if it's $100,000 at that point. Mm-hmm. You're just pretty much mindlessly just putting in money because you have conviction around that company or around that asset class for the long term. That's what dollar cost averaging is. It takes away the guesswork or emotional behavior, and you're instead going, I don't care what the price is, I'm just going to keep putting money in, right? And one should think they should do a financial health check every 2 to 3 months. Mm-hmm. But it's essentially going, I don't care about the price of the actual asset, I just want to keep getting more.
Yeah, awesome. And I think we'll definitely dive deep into those when we talk about stocks and where I bring someone in. We talk about crypto and NFTs, where dollar cost averaging is applicable. So basically, what it is based on my understanding, is what you said is, it's 1 month it could be $100, and the next month could be $80, and the next month could be $120. But irregardless, if you're just investing at that period of time that you set, it normally averages it instead of always buying high or anything like that. It's just averaging out over time. So you get less guesswork, and you're basically, the lower the average, the better for you. But we'll definitely dive deep into that for those who are still wondering what it is, and we can, go down with more detail. Now, property is something that's your bread and butter. That's your foundation. And a lot of people I talk to, like I said, it's the property dream. Everyone wants to have a property, but there's always a common conflation between buying a property to live in as opposed to buying a property to invest in, right? Can you explain the difference between living in the house that you bought and the difference of, buying an investment property to rent out?
Yep.
What are the implications of both?
Well, again, a lot of it is emotional when you're purchasing a place to live in, because you want to have the kitchen a particular way, you want to have the bedrooms that you want, versus if you're renting a place, you have the same sort of emotion for it, but now you're not taking out a mortgage that's going to be, 6x the amount you make, right? So personally, I rent vest, which is basically renting somewhere that I want to live and investing in areas that just make sense with numbers on paper, right? So I invest a lot in regional Australia, right? And across, in different states. So for me, I have no interest in living in regional Australia. I have no interest in living in, Western Australia or anything like that either, right? But I can invest there because it makes sense to me with, where I'm at in terms of my research. The numbers make sense as part of my strategy. Whereas renting, I can live close to the city in Sydney because that's what I want to do. Now, let's say, for instance, the place that I'm living in right now, if I was to go and purchase that, it's going to be multi-million dollars. But if I go and rent it, it's definitely not that much in terms of how much my repayments would be. So rent vesting, this common theory is, rent is dead money. It's not. If you're going to use the excess money and the excess borrowing to do other things and get into other productive assets. If you're simply renting just for the sake of renting, well, then maybe you need to get your head checked. If you are not going out there and getting educated around what else you can do with that money.
Yeah.
But essentially for me, even in our buyer's agency, we don't actually help people wanting to buy their own property because I don't know what emotionally you want to do. Because if you come to me and say, well, Ravi, I want to buy this, I don't care what price I pay for it because I really love the kitchen. I don't know how to relate to that because I don't love the kitchen. I'm not going to live there. But as a buyer's agent, I'm trying to get you the best price. And if we do that for an investment property, we're trying to buy it under market value. We're trying to get it to the point where we're looking at everything else selling in the area and going, how do I get the best deal for my client so that they can use the equity for their next property and grow their wealth?
100%. I feel like that's a very good contrast because, just to repeat what you said, for the audience is that people think they save enough money, then their parents or their friends encourage them, or whatever they heard on the news has encouraged them, buy a house and live in it. That's an asset. Technically, not really, because mate, because the common theme and the common problem I see around our community is you work a 9 to 5, you save your money, you earn income, and then you go borrow a loan from the bank, a deposit, and you buy that house and you go live in it. You are essentially tied, I don't know, 70 or 80 or even 90% of your net worth into that house in which you're living in which you're paying off of your future salary. That is not an asset. That's a liability now, because you're living in something, but you're paying off the bank, and also your future salary you're taking to pay that house off. Like I said, if that makes you happy, go for it. But do not conflate that for an asset, because that's essentially a liability. And I feel like a lot of middle class people fall into that trap as well, right? So they just need to know that difference. And what you're saying is, as opposed to buying an investment property, where if you're buying property and then you're renting out to a tenant, that's cash flow that's coming in to pay off that mortgage that you bought out, right? And that's an asset in a way, where you pay off, and that's free cash flow at the end of the day. And also, you combine that strategy where, if you have enough disposable income now, right? And this is later down the years for people, obviously we got to start somewhere, but, for your situation where it's rent-vest, where you're doing that investment property concepts, where you borrowed, leveraged, and then you rent it out, pays off your mortgage itself from the cash flow from the rent. But also you have the freedom, because now you're renting that money to live in an apartment or a house where you live in. That's still freedom, because you can get up and move anywhere else where you want to, as opposed to buying a house where you just got tied to for the rest of your life, or maybe 40 years or so until you pay it off. So that's the difference between those two things. Is that right?
Yeah, correct, man.
Yeah, awesome. I think in summary then, we talked about a lot of things, and just to wrap up, what are some of the practical steps that people can get started right now? Obviously, we talk about, and you can validate with me, is that obviously invest in your education, invest in, and hopefully revise what we discussed today was, understand how how money works, how inflation works, what banks are doing when you're just saving for the purpose of just saving, and why you should invest because of compound interest, and understanding what asset classes are out there, and obviously have sound advice, and do your homework before you pick something to start off with. Understand that the couple of years at first is going to be boring, it's going to be low returns, but you're building a foundation for the rest of your life. Is that correct? Am I missing anything here?
No, man, that's exactly it.
Awesome. Well, I'm going to ask this question every time I finish a podcast. What are 2 books that you recommend, and 1 podcast that you recommend as well for the audience?
So for me, I am like a Gary Vee fanboy.
Yeah.
I've been, following his stuff for like 6-7 years now. So Gary Vee, the audio experience, that's probably the podcast, because he's talking to a range of people, but he's also talking about things like side hustles to get started. Not even just investing, right? It's just the mindset stuff. And he's obviously into like crypto, NFTs and whatnot, but it's the side hustle stuff that got me started, and that side hustle stuff led to where I'm at now. So definitely that as a podcast. If I was to go down the path of reading, Rich Dad Poor Dad by Robert Kiyosaki, everyone's probably read it already. If they haven't, go read it again. And if you have, then that's awesome. And the other book would be The Bitcoin Standard. I don't know who wrote it, but that is a very big book in terms of how you understand Bitcoin. Right. And, I'm definitely not someone who comes around and be like, oh, crypto is the best, and, Dogecoin and this and that. I just think it's, if there are smart people out there doing this stuff, it's probably worthwhile to try and get educated, because they're a lot smarter than you and I, right? They're in the position they're in. So let's just try and start learning from what they're doing. And there's a lot of smart people moving a lot of money into things like the metaverse and NFTs. Let me try and figure out why they're doing it. Let me see it from their perspective.
Yeah, 100%. Follow the money. That's the main rule here. So for those who don't know, Robert Kiyosaki, Rich Dad Poor Dad, that teaches you just the mindset of how to approach money, what the middle class people are doing wrong, and as opposed to what rich people are doing. So that's a great book just to start off how you should reapproach money. 2 was The Bitcoin Standard. I haven't read it, but based on my understanding, it's teaching the concept of Bitcoin and the future of cryptocurrency, and why it's important and why it has potential to be I don't, from my view, I don't think it's going to replace, but it could. But it is a new currency that we should look at because, like you said, you're going to follow the money. If smart people are doing it, look into it. And Gary Vee, as podcast, mate, that's something that, if you want to start your own business, your side hustle, or just advice overall, I think you set up a very good foundation, how to approach money. There's an asset class right there, which is Bitcoin cryptocurrency, and also Gary Vee, which is just a side hustle and overall life advice. So, yeah. No, Ravi, I appreciate you for jumping on. I understand you're a busy man, but hopefully we can get you back for another podcast around just property itself when we dive into that asset class. But otherwise, I hope the audience has found this advice useful. And feel free to comment, like, subscribe, and drop us a message if you want any further, details to elaborate on. But yeah, appreciate you jumping on, Ravi.
No, I appreciate being here, man. Thank you.
Easy. See you guys next time.